Good morning and welcome to the first in the series of Responsible Pathways. We have a fantastic event for you today. My name is Steve Kenny and I am the Chief Distribution Officer here at Square Mile. My job today is to guide you through the first part of the event. However, to set the scene, a couple of stats. You may have seen recently a well-respected asset manager in this space published details of a recent survey that showed in the last 12 months, 80% of wealth managers and 64% of advisors that had been surveyed stated they had seen a marked increase in clients asking about investing sustainably. In 2020, responsible funds accounted for 38% of net fund flows, according to the IA. During the last 3 years, the volume of funds in responsible funds has doubled, and the IA state that it is the fastest growing area in the mutual fund market. And to prove that this is just not a UK or European phenomenon, Bloomberg published a report in the summer which predicted by the end of 2025, a third of the world's invested AUM will be in ESG, responsible style investments. So this truly is a global phenomenon. But just when you thought this area could not get more exciting, it did. And I mean, it really did. As if the UK government knew about today's webinar, yesterday they published the roadmap for green finance, a roadmap to sustainable investing. A fantastic document of 48 pages, which is seen as a statement of intent by the UK ahead of COP26. I genuinely believe that it will help address what has been termed ESG fatigue in the advisor market, because it gives clear indication of timelines for consultation papers, following which there will be regulation. The asset managers and owners will be asked how they will take into account client sustainability preferences. There is a whole page on financial advisors and consumer disclosure. The indication is within 1 to 3 years, we'll have increased and explicit sustainability disclosures that we will need to discuss with clients. So the regulation is actually starting to appear, which will generate further interest in this space. Now, I don't want to steal the thunder of our panelists today, so I'll say no more. The document is on the web and you can find it through a search looking for Green Finance, a roadmap to sustainable investing. We will be placing the document on the Square Mile website later today under the responsible section. It will, of course, be subject to numerous column inches going forward. Now, we do have the facility for you to submit questions as we go through today, and I would encourage you to do so. We have a fantastic agenda, as I said at the start. Firstly, we've asked 3 of our sponsors, 2025, what's your predictions in relation to responsible investing? Now, I would emphasize in this wonderful compliant world we now live in, these are predictions and not promises or guarantees. We will hear from Aberdeen, JP Morgan and 91 in this regard. We will then have one of the foremost research companies in the UK, Research in Finance, share their latest research from both the consumer, our end clients, and the advisor market on the subject of responsible investing. We have the pleasure of Annalise Toberman, Associate Research Director, and Jack Dominey, Research Manager, who will share their thoughts and facts in the most recent survey. After this enlightening session, we'll have time for questions. And again, I would encourage you to ask questions. I will then introduce questions from the road. At Square Mile, we have 5 members of the team who meet with advisors regularly. Today, we have Scott Dakers, who's asking questions of our 3 asset management experts that he has been asked by your peers when he's been out and about. The 3 experts are from Schroders, T. Rowe Price and Federated Hermes. Following which, my colleague, Jake Merler, will then take over for the remainder of the event with his live panel from Aberdeen, JP Morgan and 91, with a focus on climate. COP26 is only a matter of weeks away. What will this mean for our industry and the impact on investments? He will then close. I would state that this event does qualify for CPD and we'll be delighted to supply certificates. We would also welcome your feedback and please do complete the questionnaire on responsible investment. Finally, before we kick off our first session of videos, I wanted to thank our sponsors. You'll be hearing from 6 of them today. There are a further 7 you'll be hearing from in future sessions, namely Aegon Asset Management, AXA IM, BNY Mellon, Invesco, Jupiter, Elgin, and the Natixis. Plus, of course, the 6 from today, Aberdeen, Federated Hermes, JP Morgan, 91, Schroders, and T. Rowe Price. My thanks to them, as without them, this event would not be possible. Now, without further ado, over to the predictions for 2025.
I have 4 main predictions for 2025. The first is that by 2025, the relative cost of electrical vehicles will equate to the average cost for traditional internal combustion engine vehicles, and that this will represent somewhat of a tipping point for the demand for electrical vehicles. My second prediction is that there's going to be a significant increase in litigation associated with the energy transition and greenwashing in particular, as the commitments of companies, asset owners, and asset managers and the credibility of those commitments comes under much greater scrutiny from a variety of stakeholders. My third is actually that some of the consensus around commitments to net zero 2050 will begin to fracture as it becomes clearer that the world is not on a net zero 2050 pathway, and that the probability of getting onto that pathway is diminishing, particularly as government policy commitments and actions fall short of what is necessary. And finally, I expect there to be a broadening in ESG interest and focus much more into the S component, diversity and inclusion, social inequality, and other such matters, partly driven by the expansion of the EU taxonomy into those concerns, although this focus will also be more politically contentious because there's a wider variety of views as to about exactly what governments and asset owners and asset managers should be focusing on.
Globally, sustainable investing represents around 36% of total assets under management as of end 2020. Today, the majority of this sustainable investing assets are in ESG integration or negative slash exclusionary screening type of investment styles. But we expect investments aligning with a 1.5 degrees pathway or working towards net zero by 2050 will become a mainstream in the next 4 years or so. This conviction is supported by the latest science of climate change as well as governmental policies. In terms of commitments coming out from countries and locations, in 2019, just 2 years ago, only France and the UK had announced net zero targets. By March this year, they had been joined by a further 8 G20 jurisdictions, and the US, India, Australia, etc. are forecast to announce their net zero emissions targets by 2023. We expect systems to support these types of commitments, such as carbon border adjustment mechanisms. This will increasingly become a part of baseline policy. 10 countries forecast to adopt higher ambitions on carbon pricing, and the US forecast to adopt a national carbon pricing system by 2025 or as early as 2023. There will be significant push to align our investment portfolios, policy, and the whole financial system itself to the shift to low carbon economy. We also expect that there will be progress around a globally consistent sustainability reporting system or disclosure for both investors as well as corporations. So investors can be more explicit about the types of negative and positive impact an investment will make to the whole society.
2020 will be etched in our memories as the year the COVID pandemic took hold. But it should also be remembered as the year we saw significant progress on government commitments to targeting net zero. We had the European Green Deal, China's commitment to net zero, and a change in US president, which then paved the way for greater commitment across the Atlantic. By the end of 2020, around 2/3 of the world's emissions were covered by some form of commitment to net zero. And this year, 2021, can arguably be defined as the year of corporate net zero adoption. Within the investment world, we've had important initiatives like the Net Zero Asset Owners and Asset Manager Alliances prompting collective action. But we have also seen companies right across the globe and across all sectors setting net zero targets. When I checked this morning, 1,800 companies have verified science-based targets now for achieving net zero. And a further 900 are lining up waiting for their targets to be approved. So across governments, the investment industry and the corporate world, we have seen a shift in focus on net zero in the last 2 years. But what about the individuals? What about you and me? What about the pension savers and the employees? Well, our own sustainability survey suggests that this is an important and powerful group to watch over the coming years. We're due to release our 2021 Planetary Pulse survey, which assesses the views and sustainable preferences of over 10,000 individuals globally. And our results show an impressive 74% of global investors believe that their money should be invested to make a difference. And the majority of those same investors see climate change as the key driver for wanting to invest sustainably. But it's not just about their investment habits. Research by the WWF has discovered a marked step up in recent years in Google searches for sustainable products in online shopping. So consumer habits and behaviours are shifting to selecting products and services that are better for the environment and for society. So while there is still so much work to be done by governments and corporates in driving decarbonisation, when we look ahead over the coming years, our survey and research suggest that the power of the individual is about to take centre stage in accelerating action for the pursuit of net zero.
Thank you. I hope you found those predictions interesting. Now I'm delighted to introduce Annalise and Jack, who are going to talk to you about their research looking at the consumer and responsible investing. Annalise, over to you.
Thank you, Steve, for the introduction, and good morning, everyone. Over the next 20 minutes or so, I think we have, we'll be sharing some hot off the press market insight on what the end investor currently knows and thinks about responsible investing, and how the data has shifted over time. So we'll have some comparisons to data that we've collected in previous years. We'll also be referring a little bit to responsible investing research that we've conducted amongst financial advisors, just to give a bit of a comparison and contrast. Some of you may have heard of research in finance before. Some of you may be new to us. You may have even taken part in one of our studies. Just a very quick introduction to us. It's really in the name. We are a research consultancy specialising in the financial sector, working across pensions, insurance, intermediary and private investor markets. We also have a publishing side of the business, professional power planner, which you may have heard of. Responsible investing, ESG, whatever you want to call it, is an area we feel we know incredibly well. We've been following the appeal and take up of responsible investing among pension schemes and consultants for several years now, as part of our UK institutional market study. We cover the subject a lot as well, with advisors and DFMs as part of our UK advisory study, UCAS. We've also been following trends in the private investor market. We conduct a retail customer interest study among private investors, and we'll be sharing some insights from this with you today. We also published a very weighty responsible investment review report early in 2019. And off the back of this, run a UK responsible investing study every year. And we blog about the subject as well regularly on our website. So do look out for updates from us there if you are particularly interested in the subject. As I mentioned a moment ago, we'll be presenting insights from our retail customer interest study, the RCI. This consists of a big annual State of the Nation type survey among 1,000 private investors, as well as smaller quarterly updates. So the research today is from one of those recent updates, fieldwork taking place in September among 315 private investors. One thing to bear in mind about the audience, most of them are self-directed investors, although we do have a good proportion of fully or semi-advised investors in the mix. So it might not look exactly like your typical advised clients, but still quite illustrative and good to help you understand how to relate better to clients. We'll also refer in a couple of places to data from our UK Responsible Investing study, to compare the financial advisor perspective with that of the end investor. Quick introductions to ourselves. My name is Annalise. I've worked in financial market research for about 11 years now. Much of my day-to-day is interviewing professional and private investors on a whole range of topics, responsible investing including. And that's an area I'm particularly very passionate about. I got really stuck into the subject when I wrote that Responsible Investment Review report over 2018 and early 2019, and find all the research we do in this area really fascinating. My colleague Jack has worked in market research for several years as well, across both qualitative and quantitative research projects. Responsible investing, also a topic he's keenly interested in, and he manages several of our studies which cover this area across institutional advisory and private investor audiences. So what we'll be covering in the session today, I'll be talking about awareness and understanding of responsible investing, or RI as we can call it, the level of interest from private investors and the drivers behind this. I'll then hand over to Jack to discuss how satisfied investors are with the information communication that they're receiving on the subject. Related to this, the persisting barriers to further engagement with RI and how these can be overcome to some degree, i.e. the power of stories. And we should have some time at the end for Q&A, so please do get your thinking caps on. Over the last few years, one very simple question we've posed to private investors is, in an investment context, what do you think ESG stands for? When we first asked this in December 2018, only 13% could correctly spell out the whole acronym. A quarter stated correctly for environmental, but you can see that sort of the percentages go down with S and further with G, only 17% correctly naming governance in that year. So as an industry, we were happily bandying about this term, but it left even relatively savvy investors baffled. I remember fondly that some of the guesses included eggs and sausages for this particular question. But familiarity with the acronym has really come a long way. As you can see on screen here, in September 2020, much better understanding and awareness of the term across the board. Over almost 2/3 could name environmental and just under half could name social and governance respectively. And now, there's been a noticeable increase in recognition again. 4/5 of investors now know that the E stands for environmental, just under 2/3 the S for social, and 7 in 10 know the G stands for governance. So we have come a long way. And overall, 50% of investors were able to correctly spell out the acronym. Having a closer look at what private investors are saying about ESG and what it means to them, it's clear that the topic in this way of investing is becoming much more front of mind. This increase in awareness is in large part due to the platforms that they're engaging with, the likes of Hargreaves, mentioning a lot more. Interactive Investor now even has an ethical select list available. And investment magazines like Investors Chronicle are talking about it as well. It's even permeated more into mainstream media. Very recently, the BBC website had an article talking about green investing and how consumers can get involved. And some investors recognise that ESG can mean several things and that the area is quite complex and nuanced, as you can see from this bottom left quote here. In theory, it's supposed to be companies that look at, care for the environmental and social and governance. They're not going to have people working in sweatshops. They're making sure the company follows the rule that they set. Still, we feel that knowledge of this area is still relatively superficial among end investors. They know bits about it, picked up on things that they've read, and potentially know that it's not quite the same as ethical investing. But only a small minority truly understand it and what's behind the acronym ESG. As Einstein once said, any fool can know, the point is to understand. Financial advisors are going to play a huge role in bridging the gap between knowing and understanding here. Your clients will be looking to you to really break down for them what can be a really complex area to get to grips with. What do all these terms mean? And should I care about them? Are they relevant to me? What sorts of investments are actually available in this space and which suit my circumstances? And will they still help me achieve my overarching financial goals? In terms of investors' level of interest in responsible investing, there is a reasonable degree of interest, and this has increased a little year on year. A quarter state that they're currently investing in a responsible way. That's up from a fifth in September 2020. And just over a fifth, 22%, say they've been researching RI. What is significant here is that a year ago, a quarter of investors stated that they had no interest in this area. You can see from that red bar, compared to just 16% now. So there is far less outright rejection of the idea and greater openness. In terms of what's actually driving investor interest in RI, the top 4 reasons here really stand out. There's a desire to avoid harmful companies or activities, but equally a strong desire for positive impact. When we asked this question a few years ago, only a third said they were taking an interest because of a desire to have a positive impact. So that's been a big shift that we've seen. Greater airtime for climate change issues is also impacting opinion, 52% say so here. And this is another area where opinion has shifted in recent years. In December 2018, just 31% cited recent climate change developments as a reason for being interested in this area. You can group some of these drivers to get a better picture of investors' motivations. So these top 3 reasons are really what we would call values-based. Investors wanting to do good, avoid harm, invest in a principled way, aligning to their values. These ones here are financial, the strong performance of certain responsible funds, and to a slightly lesser degree, wanting to invest in a way that looks out for long-term financial risks from climate change and the like. Not registering as prominently as other reasons, but still significant, is the impact of the pandemic. This could be viewed as values-based or financial. Values because investors want to see a better society emerge from the crisis or a green recovery. Or it could be financial with sustainable investments holding up well during this difficult period. So we see a mix of values-based and financial reasons for taking an interest in RI. We asked private investors in December 2018, September 2020, and again this year, how they feel investing responsibly impacts performance. A few years ago, 12% believed that it would more likely improve performance, 22% more likely hinder. Today, 23% think investing responsibly is more likely to bolster performance and only 15% more likely to hinder. So there is greater awareness of the actual returns potential of some of these sustainable or impact funds, or of fund managers simply considering ESG factors more. A lot of private investors will have in fact experienced and enjoyed strong performance from the likes of Liontrust, Arlam, Baillie Gifford's Positive Change Fund. When we asked advisors and paraplanners the same question in our UK Responsible Investing study at the end of 2020, over a quarter believe RI is more likely to improve performance, 12% think it's more likely to hamper returns. We've excluded the DFM results here. Just for your knowledge, they hold a much more favourable view of the performance impact of investing responsibly. 50% of them believe it's more likely to improve performance. So they're much more behind responsible investing at this stage. We were interested to know if investors would still be interested in responsible investments if these did hypothetically entail sacrificing some return. As you can see from the chart here, opinion is mixed. A fifth are not at all willing to sacrifice performance, a quarter are fairly unwilling, and just over a fifth are relatively willing, scoring a 4 or a 5. But then we did see on the previous slide that actually only 15% of investors believe that this hypothetical would be the reality. Most didn't think they would have to make this sacrifice. And opinion is shifting towards greater environmental and social awareness, as we see with this comment here. This investor is suggesting that ESG considerations and output should be reported alongside past performance and genuinely form part of the investment decision. Something we're hearing in discussions with advisors is actually that those clients who out of the blue bring up responsible investing in meetings are not necessarily the clients they expected to do this. They're not all sort of young millennials, if you like. You may be surprised by who would sit in this willing to sacrifice performance category unless you have sort of an open conversation on it. I'm now going to hand over to Jack to talk about satisfaction with RI-related communication.
Thank you, Annalise, and good morning, everyone. So information sources are not only important to private investors when it comes to responsible investing and learning more about the subject, but there are now many different sources competing for that attention. This chart on the slide here demonstrates the satisfaction that private investors have with those different sources of information when it comes to communicating on and explaining RI. That bar at the top there, financial advisor, wealth manager, does see the highest net satisfaction score. This was only asked of those investors who have an advisor, and so the sample size is slightly smaller. Among the other sources of information, consumers are more likely to be satisfied than unsatisfied overall, which is positive, with the exception of mainstream news outlets at the bottom there. As you can see from all the bars, it's quite a fairly sort of mixed picture, and around a third are neutral, giving a score of 3 in yellow there for most of the answer codes. The grey portion of each bar indicates the proportion of private investors who don't have an opinion for that information source, likely because they have not used or accessed this. Mainstream news outlets has the lowest net satisfaction score of a fifth, with around a third unsatisfied. So I think this shows that there's much work to do here for publications, for platforms and fund managers as well, to understand what it is that private investors want to know and see when it comes to responsible investing. Take them on that educational journey and provide the explanations that they seek. This is very much linked to the findings we have on barriers to RI in a couple of slides' time. So as we've seen, opinion is very much split on how different groups are communicating on RI. We feel it is important to show both sides of the coin here in terms of advisors. Advisors mentioned for doing a strong job here explaining the terms and factors around RI in a clear way, that is linked to risk and return as well. Having an open conversation backed by that sound understanding and knowledge of the various elements to RI, as well as the challenges, can lead investors developing their perception and their own knowledge in this area, which is really important. Another key aspect to the communication is around trust, making things simple and articulating terms and concepts with transparency. The use of complex terms and jargon, which admittedly the industry has bandied around a fair amount, will not work for consumers anymore, as they can simply switch off, especially if they do not have an interest in RI in the first place. Consumers who are not satisfied with their advisor when it comes to responsible investing most commonly cite the complexity and unclear terms associated, which are then not broken down and explained clearly, as well as their advisor simply not bringing up the subject at all. Given the complexity around RI and the plethora of terms, the plethora of funds available, and the different types of investing, we have found that some private investors are unwilling to broach the subject themselves as they can be unsure where to start. So it really is important to have that open conversation and understand their opinions, and then almost work backwards to what funds might be suitable and what might be relevant to their situation. So now looking at some of the barriers facing private investors that I mentioned earlier when it comes to investing responsibly. Given there is still a little way to go to see more understanding and also actual investment in responsible and sustainable funds, as shown in the last few slides, understanding those barriers is obviously crucial. So looking at the most recent data we have here from September of this year, we still see a good proportion, albeit a slightly smaller one than previous year, admitting that they lack knowledge or confidence, shown in the second bar there at 38%. Indeed, this was actually the top barrier mentioned in the research from a year ago. But the biggest change that we've seen is growing cynicism regarding the validity of fund managers' sustainability claims. This is now the top barrier, with 44% of investors citing this compared to just 31% a year ago. Some might be genuinely disappointed with what they've seen, others perhaps just natural skeptics. Advisors, therefore, need to have a good handle of what is under the bonnet of responsible funds and whether claims from fund managers are what they seem to be. As per the quote on the right-hand side here, advisors need to help investors to navigate this area and therefore make better informed decisions. The barriers mentioned in the other code from the chart on the last slide are shown here. Some of the examples being a lack of agreement on standards, worried that fund managers are jumping on a bandwagon when it comes to RI, unsure about the impact of RI on returns, and the perception that some of the funds are overvalued. One investor states that a barrier to investing more responsibly is actually themselves, as shown in the bottom left of this slide, which I think does indicate that there is an opportunity for advisors to assist consumers here and explain the benefits of RI, as well as what might be suitable for their specific scenario. So looking now at the barriers among retail intermediaries, you can see the top 3 barriers stated by investment advisors here in our latest UK Responsible Investing Study, or UCRIS. These barriers are actually the same amongst DFMs too. And there's also certainly some resonance when comparing to private investors from the last couple of slides with regards to a lack of consistency in fund managers' definitions, reflective of how private investors are concerned about greenwashing. And clearly, whilst there have been plenty of responsible fund launches in recent years, such as risk-related multi-asset funds, we note that advisors and DFMs are now looking for a developed track record in order to bring them into the consideration set. As one paraplanner states on the right-hand side here, they believe that there are still gaps in lower equity content funds for a more cautious profile. Interestingly, a lack of knowledge and the belief that responsible investing could hinder performance were both in the top 3 barriers for advisors in the previous wave, but are now lower down the list outside of the top 3. And this perhaps shows how understanding has developed amongst advisors and discretionary fund managers, but now greater transparency is needed in order to continue the momentum. So explaining investment themes and framing the conversation in terms of both the impact investors can have with their investments, as well as the returns that are possible, is the way forward. Providing the context in a way that will make investors comfortable and confident, we believe, is crucial, as shown by some of these example quotes from advisors and a paraplanner from our UCRIS research. The quote on the top left states that for most people, the broad idea that they are doing something positive with their money is a winner. And the quote from the Power Planner on the top right highlights how intermediaries can look to provide an opportunity through effective communication. Show that there isn't a performance detriment that you pay, that the risk can be managed, something that clients can really buy into, which means a lot more to them than just investment returns. So we've talked about providing context, being clear, being transparent when possible, and taking investors on that journey. And this is ultimately what it's all about. This is a quote from a professor of cognition and education at Harvard University, Dr. Howard Gardner. Stories constitute the single most powerful weapon in a leader's arsenal. And Annalise and I believe that storytelling can be extremely powerful when it comes to explaining something like responsible investing. Highlight some examples of what asset managers have been doing. Find some companies within a fund who have helped the environment in a certain and specific way. Make the topic tangible, make the topic relatable to the end investor. This will give those investors something to grab hold of, something to take on board, and therefore understand the terms and the language more effectively in time. Telling stories really does have impact, and that's something we've seen in a lot of our research. So with this in mind, here are some of our recommendations based on our research of how to engage with the end investor and make an impact when it comes to responsible investing. So as I've said on the last slide, telling stories, bringing the content to life by giving examples of companies that have earned a place in a sustainable fund. And instead of trying to be bogged down by terms and jargon, try to show the spectrum of investing and the shades of green, from traditional investment to philanthropy. Providing the context and the bigger picture will likely be more impactful than focusing on the complexities and the intricacies, or at least at first. And share providers infographics on sustainable investment themes where available and where possible, as well as impact reporting in order to engage and interest the investors through visual aids. As the quote on the right here says, demonstration through storytelling can really help to bring an idea to life. So just to sum up what we have been through today, ESG is increasingly recognised by investors with interest driven by a desire to have a positive impact and avoid harm. Some additionally see RI as an investment opportunity. However, barriers to greater engagement remain, principally a lack of true understanding and a lack of trust in the credibility of sustainable funds. Advisors do have an important role to play, therefore, in overcoming these barriers, making the subject relatable to clients, and demanding more from fund managers regarding clear and transparent information. So for the last 5 minutes or so, we welcome any questions that you may have, as Annalise and Steve mentioned earlier. And I'd like to now pass back to Steve.
Jack, thank you very much. That was excellent. And I think my observations would be that there is high trust in the advisor community from your research, but there is a doubting Thomas, for want of a better expression, in terms of the asset management community, in terms of their propositions. A couple of questions just to kick off, because as you say, we've only got 5 minutes. Do you feel that the timing of your September research influenced the caution in terms of the skepticism on asset managers? Because during the course of the summer, we had a pretty high profile asset manager accused of greenwashing. Did you get any sense of that through your research, that that might have been the case?
I can take that one. So as Annalise mentioned at the start of our presentation slides, we do conduct research on an ongoing basis every year around responsible investing, and greenwashing is something that has come up both in our UK responsible investing study and actually more recently in some of our private investor research, such as the retail customer interest study. There are some nods to certain asset managers who some investors or retail intermediaries believe are greenwashing, and it certainly is an issue and a great concern. As we saw in the slides, it's now the sort of top barrier to investing more responsibly. So we do have a few mentions when it comes to certain investment managers, but there's certainly a nod to greenwashing being a significant issue, and it's probably increasing all the time, and it's now sort of overtaken sort of lack of confidence and knowledge in the area as a barrier for sure.
I would just add there that when you look at trust in the asset management industry versus other segments of the financial sector, it's always lower anyway. So I think there's a natural skepticism potentially coming through as well. And that element of a little bit of knowledge is dangerous. So now they know what this is and they understand it and think it could be interesting. That's when the cynicism starts to come through. There's definitely a mix of investors genuinely looking at top holdings and questioning them when they're looking at some of these investments that are badged as sustainable. But I think there's also a large swathe of investors who maybe haven't done that digging, but do believe that that would be an issue if they did.
Cool. Thank you, Annalise. And Annalise, probably one for you. Why do you think investors struggle, in particular with regards to the language and terminology around responsible investment? You touched upon that during your sort of session.
I mentioned early on that even the BBC website now has articles on green investing. And I think Jack and I were having a chuckle going through it because they mentioned green, environmentally friendly investing, responsible, sustainable. It's very hard not to fall into the trap of using several terms. And while I think we do have a broad understanding now in the industry and amongst investors of what sustainable investing could mean, there's lots of terms underneath that, such as engagement, that private investors and even actually some intermediaries aren't so familiar with. Impact investing, which is obviously a subset and means something slightly different. So there is quite a lot to get to grips with, and I don't think necessary providers and media are very helpful because they do switch between a few at once. And obviously in terms of fund labeling, we don't have consistency there either, which just muddies the waters further.
Cool. And Annalise and Jack, I'm afraid we've run out of time. I want to thank you on behalf of the audience. That was an excellent presentation and your insights were very, very useful. I think all the advisors who are listening will draw heart that the trust in them and the role they have to play in terms of helping the consumer navigate this particular area of investment is very important and is going to continue to grow. So thank you very much, Annalise and Jack. I am now delighted to say we're going to have a pre-recorded video with Scott Dakers asking questions of our three asset management experts that he has been asked when he's been out and about. They are Schroders, T. Rowe Price and Federated Hermes. Following which, my colleague Jake Moeller, Senior Investment Research Analyst, will be dealing with the panel with representatives from Aberdeen, JP Morgan and 91. I will now play the video.
Hello, I'm Scott Dakers, Business Development Director at Square Mile. Today I'm going to be asking three of our sponsors some key questions we get asked by our clients when we're discussing responsible investments with them. Firstly, are we seeing a price bubble in responsible investments, and could these drive price fluctuations?
So let me give you the case for a bubble and a case against a bubble. In terms of a case for a bubble, we're seeing an influence and effectively a huge amount of pressure on governments, on regulators, on fiduciaries and on clients to understand the nature of their investments and to invest more responsibly. And that's occurring in a world where you've got an excess of cheap credit and in a world where we're seeing more factor investing and passive investing than ever before. Now, that certainly has consequences in terms of capital trying to find the right side of ESG. And we saw last year, certainly in the E part of ESG, that there was unequivocally heat and momentum and inflows that we would say certainly created perhaps areas that were behaving a bit like a bubble. However, The case against is that we're at a relatively early stage in terms of responsible investment. And therefore, you are seeing these same influences from government, from society, from regulators, fiduciaries, and clients, cause companies to react, to change, to start to both invest and behave in different ways. And that's going to expand tremendously the opportunity for responsible and sustainable investing. And that is effectively the cure for a bubble, broadening out of the opportunity set and effectively preventing that narrow crowding into certain segments of the market. I think the other thing that we can talk about is responsible investing is a very broad church. And therefore, we're very early in terms of managers and fiduciaries' approach to engagement, as well as their approach to understanding ESG as a risk and an opportunity. And I think there's huge amounts of progress that can be made in those two elements without them really influencing the prices of assets, which tends to create that bubble that people are worried about. So if I was to summarize, I think we have seen and will continue to see areas of ESG and responsible investing require management from a risk and a valuation perspective. But I actually think there's a huge amount of change, positive change, and putting your portfolio on the right side of that change and expanding opportunity set actually is a way to reduce that potential narrowness that creates the circumstances for a bubble.
How crucial is disinvestment and what drives that decision?
So when thinking about divestment, we consider two things as an impact manager. Firstly, what levers do you have to create change? And that depends on what instruments you're talking about. Those from public equities to private equities differ in terms of the levers available to impact managers. Similarly, in public credit versus private credit, the levers available to a manager to enact change differ. So understanding those levers is important to any future divestment decision. Secondly, why did you buy that instrument in the first place? What was the intended impact outcome you were looking to deliver? At Blue Orchard, as an impact investing specialist, we follow the three pillars of impact investments. And so this is the intent to contribute or to add additionality to measurable social and environmental performance alongside financial returns. That means at the outset, there is a clear objective around what impact we are looking to intend to happen with each and every investment. So thinking about our public debt strategies, it's really around engagement prior to investment. However, following investment, divestment happens within our portfolios only if the ESG or the impact outcome has changed. And that's where it's incredibly important to continue to monitor, engage with your investments and investees, and divestment is the ultimate stick for those positions. But at Blue Orchard, given the high bar of anything entering our portfolio, following the exclusion lists, but also the bottom-up active impact assessment we deliver, actually divestment in terms of business models doesn't happen with us. Divestment only happens to us or within our portfolios when there has been a change in the ESG risk or the impact outcomes delivered by that portfolio.
The market talks a great deal about responsible investing. With COP26 happening this year, environment has never been higher up the agenda. However, the social aspects of change tend to be forgotten. So how are social changes reflected in your portfolio?
I think for us, social and environmental aspects are in many ways interconnected. If we fail to address climate change, there's social consequences. Alternatively, if we go too fast on decarbonisation, it'd be equally harmful from a social perspective. I think part of the reason why sometimes people focus more on climate is that everyone can agree that carbon emissions are the metric to monitor, and whether it's investors, governments, corporates, from east to west and across sectors, everyone agrees that we want to focus on carbon emissions. That's why we're seeing these carbon pricing schemes rolled out globally. Social aspects are more nuanced, and there's no single metric or KPI for investors to focus on. And I think that's why at times it goes overlooked. these social aspects can be quite local rather than global. They can be specific to the industry, the geography, and cultural differences. Within the EU taxonomy, for example, we have environmental objectives specified, but we don't yet have any social objectives. We believe those social aspects are really important. They're just harder to assess in a quantitative way. We really think about two areas when we're speaking and engaging with companies. Firstly, on human rights and how they think about their supply chain. Are they just outsourcing problems, or are they really investing in their suppliers? The second aspect is around human capital and viewing human capital as an asset rather than just a cost in terms of wages or benefits for employees. And I think currently when you see shortage in HGV drivers like we see in the UK, you recognize the importance of building that human capital. So I think to really understand these aspects, you need to engage with the companies. We also think about the two social themes within our portfolio, health and well-being, which covers everything from pharma to life sciences to nutrition and fitness. And secondly, inclusion and thinking about the disparities in access to education, financial products, and other goods and services. I think COVID showed how fragile society can be and the importance of investing in health, in systems and infrastructure. Both of these are themes that we think will become increasingly prominent in future years. So I think in summary, social can be overlooked because of this desire to reduce everything to a number and to simplify. And social doesn't lend itself easily to that. So while everyone focuses on climate change ahead of COP26, we think investors would benefit from not losing sight of those social factors. The best long-term investments ultimately are often in those areas that are overlooked.
Hello, everybody. Welcome back after the questions. We are now going to our live panel, and we're talking in this session about the industry's role in the race to net zero. And we're going to cover a little bit about the environment, low carbon, net zero, COP26, lots of good stuff to cover. And I am joined, and I'd like to welcome three outstanding experts in their field with three very reputable fund managers. Jennifer Wu, who's the Global Head of Sustainable Investing at JP Morgan Asset Management. Graham Baker, Portfolio Manager 91 Global Environment Strategy. And Jeremy Lawson, the Chief Economist and Head of Aberdeen's Research Institute. Thank you all for joining us. Before I jump in with a question, just on the back of some of the discussions we had in the last session, we actually did a straw poll on LinkedIn saying, can we do enough? Are we doing enough? Has our industry doing enough for climate change? 5% of respondents, and it was a reasonably material number, said, yes, we are doing enough. 48% of respondents said we are not doing enough, but we seem to be making progress. And 47% of respondents said, no, we are not doing enough and more needs to be done. So perhaps we can keep that in mind as we go through this. So starting off with net zero, I'd like to ask each of you what net zero actually means and how do you define it? Perhaps, Graham, if I could start off with you on that, please.
Yeah, thanks, Jake, and thanks for having me. Great to see everyone on the call today. We've done a lot of work on decarbonisation and understanding the risks and opportunities that come with climate change. And when we think about net zero, it's real world net zero. So effectively, the entire planet, the global economy, getting to zero carbon equivalent emissions. So it's not just carbon, also methane, etc. And I think one of the key points is that it's the real world. Easy to shift a portfolio to make it look like it is potentially aligned with net zero in the future, i.e. you could buy a lot of software companies, sell a lot of slightly higher capital intensity businesses, and you could see a scope 1 and 2 carbon emissions intensity change for that portfolio. And you could be very happily saying you're aligned with net zero in your portfolio, but that is not real world net zero, and that's not going to help us solve this huge problem that we face as a planet. And I think one of the key points here is to look at emerging markets and to understand that also when you look at a portfolio, you can't just sell out to emerging market names because they are high carbon intensity, you need to work with those companies, engage with those companies, try to help them report carbon emissions and alternative emissions, and try to help them understand a pathway to real world net zero. So I think that is the key point for us.
Thanks very much. Jeremy, could I get some views from you, please, on net zero?
Yeah, so I'd agree with everything that Graham has said there. So maybe what I will add is sometimes the phrase net zero and net zero 2050 are used interchangeably, but they don't mean the same thing, right? So net zero, it's right, Graham's defined that appropriately. But the temperature pathway alignment that, let's say, the global economy is on, and by definition, sort of the average across financial markets will more or less be on. So these matter significantly on what time horizon you're talking about, right? So actually probably earlier than 2050 is now required to be on a 1.5 degree pathway. Net zero by 2070 would be something closer to a just below 2 degree pathway. And then net zero beyond that is when you sort of get into full overshooting of Paris alignment, of all Paris alignment targets. And the problem we have at the moment, both globally and in our industry, is that there is no net zero 2050 alignment at present in the aggregate. I'm sure we're going to get into this in more detail when we talk about COP and policy, but it is quite important because it's very, very difficult for financial flows to align with 2050 objectives if global policy is not aligned with 2050 objectives and in a credible manner. So I think it's very important for the listeners to understand that net zero, it is what is required to ever be able to stabilize global temperatures, right? You can't, you're in runaway climate change forever unless you eventually get to net zero, because you can't stabilize atmospheric sort of concentration of CO2 and equivalents otherwise, but that is not the same thing as a 2050 alignment.
Thanks. Jennifer, what's your take on that? And
Yeah, sure. Thank you for asking that question. I agree with what both panelists have said. They've defined net zero quite well, right? If you think about it, it essentially is about removing as much greenhouse gas emissions in the atmosphere as how much we put in there. And there are so many different challenges for us to get there by 2050, which is what Jeremy was alluded to. Maybe the one last thing I can add to this conversation is, why is that really important? If you think about where we are at now, we are already at above 1 degree Celsius increase from a temperature rise standpoint since the Industrial Revolution. And even a few years ago, the United Nations report already shows that the difference between 1.5 degree, and that's where we're approaching, versus the 2 degree scenario, that difference and the changes in what we see in terms of frequency of extreme weather events, and then also the impact on our climatic system is very, very significant. So I think net zero, on the one hand, from a financing standpoint, we need to be bold and ambitious and think about what are some of the levers we can pull to really make sure that there is change in the real economy by way of directing financing. But at the same time, we need to also start investing and be prepared for what we call climate adaptation, right? Because extreme weather events will continue to happen, frequency will go up. I don't think it's possible for us to really cap the temperature rise at 1.5 given existing policies as well as technologies that's available. Of course, there is still hope, but we also need to make sure that, if we look at communities that are most vulnerable, we need to be prepared for what's going to come online as well. So for me, net zero is about being ambitious with climate mitigation type of investments, but also at the same time being prepared for what's going to come from a risk management standpoint.
That's great. Each of you have raised some really interesting points there, which I'll try and round back into as we move along. Can I just remind everyone, please, that the Slido is open to take questions, and I'm hoping that you can pull in a few questions here because it's a very, very interesting and important topic. Jennifer, if I can just stay with you and bring in COP26. Now, COP26, it's a meeting of international governments and various interested parties. from your perspective as an asset manager, how do you translate what's going to be talked about there and some of the discussions that will occur there into, I guess, relevance for an investor?
Yeah, sure. So COP26 is something that we're all very excited about because, it hopefully is going to give us what we need the most now, which is very clear political commitment and policies that are going to drive behavioral change and incentivize, industries as well as the broader economies to make drastic change over the course of the next couple of decades, really. So from an asset manager standpoint, by interpreting what these policy directions are, how we can contribute to net zero or this broader decarbonization agenda, I'd say there are three ways that we can really contribute. The first one is providing our clients with the type of solutions that they need. And it could be a low carbon, product. It could be about, technologies that focuses on what we call negative emissions type of technology. So it could be things like carbon storage and capture or natural sequestration. So providing our clients with the type of solutions that they can use to also align their capital to contribute to net zero. The second thing that asset managers can do is engagement. So, we engage with companies in the portfolios on behalf of our clients. And to what Graham was saying at the very beginning, net zero is about real economy change, right? And who's actually impacting or driving the real economy? It's companies, right? Companies that we work in as well as companies we invest in. So what we can do as an investor, as an asset manager, to really engage with these companies and make sure that they have the right CapEx, R&D in place that are aligned to their net zero ambitions is going to be really, really critical. And that will obviously needs to align to what comes out of COP26 in terms of government's ambition. And I'd say the last thing that we can do really is, as an asset manager, is about investor education. It's both external and internal, right? So it's really educating our clients about the potential risks and opportunities arising from these policy changes, but equally and very importantly, educating our own investors, right? Because this is a pretty dynamic space. Policies continue to change, the science is improving, making sure that our investors, my colleagues, myself, who are making investment decisions on a day-to-day basis, we look beyond the traditional ESG issues and really understand what does it mean to be climate aware when it comes to investing, both from policy transition to physical risk exposure. That's something that we, I think, as a manager, should be focusing on doing.
Thanks, Jennifer. Jeremy, these international congresses can often be, real politic and a lot of talking without too much action. I mean, how will you see some of the trickle-down effects for investors from COP26?
Yeah, so my biggest recommendation for listeners is to pay attention to what governments are doing, not what they're saying, right? So you take the original Paris commitments, right? A lot of focus on the higher level objectives. But if you look at the actual trajectory of emissions since the Paris Agreement, and particularly sort of before the pandemic was a setback for some countries' emissions, very, very few countries were reducing emissions or carbon intensity in line with the pledges that they made at a very high level. And I don't expect COP26 to be any different, right? There'll likely be an affirmation of the objectives that were made then. We know that there have been an increase in the ambition of many countries' targets, and in some cases, sort of credible policy to support it. But for the most part, government policy today and the outlook for policy tomorrow is in no way consistent with 1.5 degree objectives and not even 2 degree objectives. And so what we do, be very clear, and this is where we think we add quite a lot of value to clients, is we analyse the political economy of climate policy decision-making in each of the major economies, not just from where things stand today, but also what the outlook for that is over the coming years. And what we do is we then embed that in the design of our climate scenarios. So we don't just take climate scenarios off the shelf, 1.5 degree alignment, 2 degree alignment, current policy, whatever it is. We design our own bespoke scenarios that really account for the way that the real world messiness of climate policy, the fact that actually building sector emissions and policy is not the same as power sector emissions for nearly any economy. The fact that some economies are moving much more quickly than others towards decarbonisation. And if you can't take that properly into account in the way that you design and analyse the consequences, then you won't really actually understand the way that asset prices and ultimately investment risk and opportunity are likely to align, because asset prices don't pay attention to high-level government targets. They pay attention to what is actually taking place. So we embed that political economy, economic sort of assessment of what is probable into our analysis, and then we embed that into our investment decision making and the way that we design solutions for our clients. So along the lines of what Jennifer said, right? Some clients have very clear, asset owners, very clear 1.5 degree alignment ambitions, and you can create sort of portfolios, sophisticated portfolios to help them achieve that, particularly if they're wanting to do so in a real world sense. Others actually, they don't want that at all. What they want is actually to make sure that the nature of the true risk that they're facing is properly accounted for in our investment processes, right? Stewardship sort of similarly, right? Different companies that you engage with are in very different parts of their journey. But for us, it all sort of has to be embedded in a realistic analytical assessment of what the future looks like, because then you can have very honest conversations with your clients and the investment community about what that future might look like and the risks around it.
Graham, how does that translate for you? I mean, high level down towards investor level, how do you translate some of these macro issues into something meaningful for an end investor? And are there any other disconnections that perhaps that Jeremy's referred to?
Yeah, well, ultimately, we need to shift our entire global economy. We need to decarbonize aggressively. I think it's becoming clear if we want to get anywhere near a 1.5 degrees warming scenario or onto a net zero trajectory, we need to see trillions of dollars being spent in some key decarbonisation areas. The latest IEA net zero report was very interesting, highlighting that we need to see over $4 trillion being spent in some of these areas, going from approximately 1 trillion today on a per annum basis by 2030. So we think there are huge opportunities here, but obviously, of course, on the other side of that are huge risks. So we try to find opportunities that are aligned with that huge shift in capital, but directly aligned to this great structural growth opportunity. So we try to find climate solution providers, the real leaders across the world that are helping us to get close to some of these positive trajectories. And that's how we feel we can shift that and really help the underlying investor. Now, as I said before, engaging with all stakeholders is really important here. And we're hoping to see some positive improvements around the nationally determined contributions, and maybe see some other positive announcements around the reduction in fossil fuel subsidies and more talk around deforestation. I think it's a messaging, it's an engagement, it's offering opportunities and highlighting the risks.
Fantastic. Jeremy, if I could just return to you for a minute. I'm going to ask a question, I guess, with two parts, but can you outline a little bit about what the race to net zero looks like? Perhaps for you as an investor yourselves, but also for you as a company. What are some of the targets that you have and some of the objectives that you're trying to set as an investor and as a company to get to net zero? And the race to net zero, I'm not overly keen on that terminology, but
yeah, maybe I'll start with that phrase and then get into what we're doing concretely. There is no race to net zero at the moment, right? Or at least it's a race that actually much of the world's economy isn't actually competing in, right? There's a subset of companies that are in the race to net zero. There's a subset of countries that are arguably in a race to net zero. Then there's a whole bunch who aren't even in the game. So that point that Graham made, for example, about the amount of investment that is required to get onto these pathways, I mean, that is all true, but that investment is not taking place. I'm sure people have been paying attention to what's happening in the United States at the moment, but there's a pretty decent chance that in the big public sort of investment bill that the Democrats are trying to get through Congress at the moment, that in order to get the signature of Joe Manchin, who's the senator for West Virginia, that the clean electricity standard may need to be dropped from that bill. But if that is dropped from that bill, there is no net zero aligned pathway. There's no chance of it even happening in the United States, right? Particularly if you sort of think about what will happen if Democrats sort of lose power in 2024. So we have to be very careful about this phrase. I mean, it's a very clever phrase, the race to net zero, and it's a way of sort of generating sort of excitement and activity about lifting ambition, which is very important. But what we don't want to confuse is what is actually happening from what we want to happen, because again, you have to analyze these things differently. In terms of what we're doing, it flows on from what we sort of talked about beforehand, right? So we've been significantly expanding, the range of net zero sort of solutions, net zero 2050 solutions that we offer to asset owners who want to be on that particular pathway. Because we embed our climate analytics across every part of our business, there is no part of our investment universe where the nature of climate risk and opportunity is not formally taken into account. And because, even though you can tell I'm not especially optimistic about net zero 2050 alignment, there is no doubt that there is still a significant energy transition taking place, right? Or another way to put that is, if you think about a global equity benchmark, right, there's going to be a significant reduction in the carbon intensity of those benchmarks over the next 5 years, over the next 10 years and beyond. And we need a forward-looking framework, and we've developed one for taking that into account and embedded in our investment process so that we are actually not just capturing that, but we're ahead of the game in terms of what types of companies you want to invest in along that pathway, including credible transition leaders. We also have, quite sort of strong operational commitments around net zero. So in particular, sort of reducing our carbon footprint by 50% by 2025, and then sort of a very active stewardship agenda as well, because that's obviously absolutely sort of critical, particularly when you're an active asset owner. So it's multifaceted, but also captures the nuance of the reality on the ground.
Jennifer, JP Morgan Asset Management, a large international house, lots of global touch points, regional touch points. How would you respond to those issues at an investor level and at a company level?
Yeah, sure. So I think for us, operationally, we have already committed to what we call carbon neutral across the operations, as well as how we source electricity as a company. And that started in 2020, right? So, it ranges from sourcing electricities from renewable sources, as well as offsetting employee travel, so on and so forth. So that's a commitment that we've made a couple of years ago and really started in 2020, and that will continue, right? So every year we aim to maintain that carbon neutral level for our operations. And then for our clients, if you think about the solutions that we put in, the way we think about climate is in two parts. The first one is you obviously want to make sure that you're capturing these risks and opportunities in your day-to-day, right? So very similar to what Jeremy said, even if a client doesn't have an explicit net zero target, as fiduciary, it's incredibly important to make sure that risks, those type of risks are captured such that we can, really generate better risk-adjusted return, if you like. The other component of what we're doing is thinking about it from a total portfolio standpoint, right? Because climate risks and opportunities is not specific to one asset class, but really helping our clients, including asset owners, so that's pension fund, insurance companies, family offices, you name it, to start thinking about at the strategic asset allocation level, how should you be thinking about net zero decarbonization and the impact from policy transition, as well as physical risks, right? And then, that will influence the way you think about, geopolitical risks, where you place your bets across asset classes. And then you go one level down to look at, different asset classes. What are the potential instruments that you could use to be more exposed to, say, renewable energy type of opportunities, or even, say, for instance, in the alternative space, exposure to natural sequestration, like forestry management, for instance. So for us, it is the commitment is to build out a full suite of capabilities such that we can help clients to tackle what they deem most important from a climate objective standpoint. So in a way, I think in a nutshell, what are we aiming for? I think for us, from a stewardship standpoint, we are aiming to speak to every company beyond just TCFD risk disclosure, but really going deep into how they set those targets that they have, how credible these targets are, how aligned are they to our own internal model as to what a right trajectory should look like for companies in a specific sector. And it could be automobile, it could be agriculture, et cetera. And then on the other hand, continue to invest in climate expertise. So that includes data, analytical tool, talent, et cetera, so that we can be, hopefully ahead of the game, but on par with how science is developing, as well as regulations and tech, so that we can, on a continuous basis, factor all of that into how we help our clients.
Graham, I know that 91, as a sort of South African-based company, initially had real exposure to some of the droughts in South Africa last year and before that. I mean, that's a real tangible effect on your business. I mean, can you perhaps illustrate, some of the things that you're doing and some of the implications for investors as a result of these challenges?
Yeah, no, and I think for us, originally coming from South Africa, originating in that country, which it does have a carbon-intensive grid, and is slightly further behind in an energy transition compared to some other countries, we fully understand the sustainability risk, not just across environmental issues, but also across governance and social issues. And that started back in private marketing, investing back in South Africa many years ago. As a firm, we've committed to net zero. We took our time to understand what that really meant, though. And we do believe in sustainability with substance. As I touched on earlier, we don't just think shifting weightings in certain industries and changing geographical weightings is necessarily the best way to solve this issue. Coming back to my emerging markets point, and obviously we started as a firm in the emerging markets. I think we have quite a different perspective from many. But if you look at really who's created this problem, it really is the Western world. So if you look at cumulative emissions, the US has created about 25%, Europe and the UK about 22%, China 15%, so is catching up and will catch up over time, and India is about 3%. So I think we need to understand, living in the Western world, that we probably should be supporting these emerging market countries in this transition, understand they are further behind, understand we need to be allocating capital there, and helping to not only educate but work with and provide capital to understand this could take longer for some of these countries. Now, when we do it within our strategy, the global environment strategy, we go into a lot of detail. It's a highly concentrated portfolio. We go into a lot of detail around the carbon emissions, looking at scopes 1, 2, and 3, if possible, for the businesses that we hold in our portfolio. And really, ultimately, we have a couple of key targets that we look at. First, we want businesses to report carbon emissions. Once they do, we want them to, and of course, carbon equivalent emissions as well, which we touched on earlier. Once they do report, we want them to understand how they could transition. They need to understand the data. We don't just want people to suddenly start reporting or aligning with science-based targets without actually understanding the data that sits within that. And once they've done that, we then encourage companies to sign up to the Science Based Targets Initiative, for example. And we have two aims of the portfolio. One's to invest in climate solution providers that are really helping the global economy to solve this issue over the next 30 years. But also we want those companies to be reducing their emissions footprint in line with the Paris Agreement. But interestingly, we're seeing those companies that are in the Western world, in the developed world, in our portfolio are aligned with that Paris Agreement, which simplistically is about minus 7.6% in emissions out to 2030. And we do see better reporting and more science-based target alignments from larger cap European or US names. So there are biases within this data and biases within companies. When we look at the emerging companies we invest in places such as China, the reporting is not as good, but we're engaging to work with them to report. And over time, as I said, we'll engage and hope they will start aligning themselves to a net zero or science-based target.
Thank you.
Jake, can I just add something on that emerging market point? Is there time to do that?
Yeah, no, quickly, Jeremy, absolutely.
Another way of sort of phrasing Graham's point is around this concept of a just transition. That it's a phrase that many people have heard, but it does sort of account for this concept that historical obligation and responsibility is not equal. At the same time, the world's problem is that today the majority of emissions are generated in emerging economies, and that proportion is only going to grow over time. So if you can't solve the challenge of how to assist emerging market governments and companies make a genuine and credible transition, and to do so in a way that satisfies their economic and social objectives as well, then you have no solution at all, right? It's in some ways the most important question, and it's sort of aligned to, right, capital needs to be deployed to where it can have the most benefit. That includes, across the world, current dirty companies that must decarbonize if the world is to decarbonize, but it also says there's that geographic sort of focus from an emerging market lens, but also actually even sort of within the advanced economies, right? Because we've sort of seen this in global trade, if communities dependent on one type of economic activity see their livelihoods destroyed for a broader aggregate goal, then politically you get pushback. And with that political pushback, you undermine the commitment for the original objective. So the just transition is absolutely essential if we're to make any progress here.
And potentially,
maybe could I just add an interesting point on that, maybe with a live example. We're seeing a huge increase in exports coming out of China, which are having a big impact on power prices, but increased coal demand within China because that's their only option in the short term. But there is a potential argument that the rest of the world is outsourcing its emissions to China, and I think that's important as we see other places around the world buying more from China as we now see another issue in the energy markets.
Jennifer, I'll give you, if you want to reply to any of those points at all, or?
No, I think those were really well said. I think there are many, many challenges that we need to tackle, right? And I always come back to like time is of essence right now. We don't have a lot of time. Political commitment, and that's what we are all hoping for from COP26. I know that Jeremy is less optimistic on that. I'm still hopeful, although probably less so now that we are so close to COP26. Hopefully there can be more clarity, because without that, there is very little chance we'll be able to really transform our economies in a meaningful way, given all the challenges that have been highlighted.
Okay, I'm trying to cover a few things before we get to questions, so I'll keep things moving, but I'll stay with you, Jennifer, I can, for the next question about portfolio construction. And there has been a little bit of reference to this already, but what are the tangible effects that changes in sort of COP26 policies, aside from regulation, might have, or how will they manifest themselves into your portfolios? Does it mean eventually that none of your funds will have investments in petroleum companies or in polluters? How do you actually solve some of the problem through your investments and your portfolio construction without actually ignoring potential investment opportunities, whether they're good or bad?
Yeah, so it's actually very interesting because we see the full spectrum from our client standpoint, right? We do have some of our clients that want to stop financing these carbon intensive sectors now for purposes such as, how they have to reduce their emissions pretty drastically from today onwards. So, by doing that, obviously, you potentially lose the opportunity to invest in companies whereby they really need capital to decarbonize their business operations. But that's client's choice, right? So we have to respect that. On the other hand, at the other end of the spectrum, you have clients who want to really, really stay invested in the most polluted companies, if you like, and do very aggressive active engagement. and with the hope to potentially change these companies. So I think where clients are at is really within this spectrum, as we are seeing across the globe, actually. And I think what's really interesting and worrying as well is there's a lot of discussions about policy changes, how that may impact the way we think about specific sectors, and then also what are the opportunities. So one of the things that's worrying is that I think there's a lot of focus on a few key sectors, but still not enough attention on sectors that really, really are hard to abate and need lots of transformation. There is more, for example, on attention on agriculture as a sector, right? They are one of the largest emitters of greenhouse gases. So, what are the opportunities there that we could invest in to help them to transition is really critical. So we're starting to see this shift from just focusing on renewable energy, electric vehicle, battery storage to other sectors as well. That's good. The other thing that we are not seeing a lot of, but I'm still going back to my earlier point about climate mitigation. With everything that's happening, what we cannot ignore is that every companies under the sun, every businesses are much more exposed to physical climate risks. So as we think about the ambition and how we can better align the capital, we also need to better prepare our clients' portfolio against these potential physical risks. And one of the things that we're doing a lot of work on and investing in is to be able to more accurately calculate and measure how likely our clients' portfolio will be under different kind of stressed environments, if you like, given what we know of from a climate science standpoint, the frequency of droughts or other type of extreme weather events. That we cannot ignore, and that is not something that I see a lot of investors doing as they think about asset allocation or making investment decisions.
Okay, following up, Jeremy, quickly, and Graham as well. How do you see that progressing? Is it, are companies, getting the weighted average cost of capital right? Are investors penalizing polluters?
I mean, again, I'm going to sort of come back to the same point or a similar point that I've made before. In aggregate, the financial sector is not going to price capital consistent with net zero if government policy is not pricing carbon, in alignment. The idea that that's going to happen independently would sort of ignore everything we've ever seen in history. This is a clear market failure. It's a negative externality. There are things that our industry can do concretely, but only in partnership. From a portfolio construction perspective, this matters quite a lot. So your starting point is, what is the client objective? Because the way that you manage a portfolio for a client who wants, say, a net zero 2050 alignment is very different for a client that doesn't want that. But equally, once you sort of start with this portfolio construction question, you always have to start with what is in the price, right? That's your starting. You can't even begin to think about how you should invest unless you understand what future do you think is priced in. Then you have to think about, well, how does what's priced in differ from the outlook that I have? And as Jennifer said, that's not just about transition risk, that's also about physical sort of risk and its manifestations, which are guaranteed to increase over time. It's only a question of how much. And then again, this is where your analytics come in. If you get your analytics right, then what you understand is that actually climate risk and opportunity is not primarily a macro phenomenon. It's not primarily an index level phenomenon. It's a micro risk phenomenon. So you take the utility sector. Utilities in many models actually stand to benefit from the energy transition, not because there aren't polluting utilities, but because electrification of other processes generates a lot of new demand for utilities over time. But there are some companies within that spectrum that are very positively exposed to that trend, others that look very negatively exposed. And even amongst the negatively exposed, there are what we call transition leaders. There are companies that are rapidly changing their business models because they recognize the nature of that challenge. And so your analytics help with your starting point. You have to overlay that with an active research process. So you can say, actually look at these two companies. My analytics say that they're both at risk from the energy transition. However, one's got a business strategy that we think adapts to that and can be sort of play a transformational role. This other one doesn't. And that's the role of capital allocation. That's the role of our industry, is to get the capital to where it's going to do the most good, where that change is occurring, to the companies that recognize these challenges and not to those that aren't.
Great, and very quickly, could I just get you to follow up on that?
Yeah, and I think Jeremy makes a great point. And if you take an example, if you look across the MSCI All Country World Index, and you were to double your weight in the three cleanest and greenest and largest utilities in the world, so Iberdrola, NextEra, and Enel, if you were to double that weight, you'd actually see your carbon emissions footprint on a scope 1 and 2 basis go up, although they are the companies that are allocating the most capital to trying to solve this issue. So it is about the detail, it is about the nuance in this. And I think to finish on a positive note, there are huge opportunities out there. And as Jennifer touched on, things such as agriculture are probably in that more nuanced bucket. And we look across all of global decarbonisation, not just the energy transition, and growing things, plants, animals makes up about 20% of global carbon emission. Industry makes up another 20%. So we're looking at the future of the factory. And we just believe that this is such an exciting long-term structural growth opportunity. And yes, there are certain subsegments within that may be pricing in closer to a 1.5 degree scenario, but there are many, many others that really aren't. And as the data shows, we are a long, long way from that 1.5 degrees warming scenario. So a lot needs to happen from here. And this is just the beginning.
Okay, we're almost out of time. In fact, we are out of time, but I just want to ask one question from the audience. I'll combine it as two. I'll start with you, please, Jennifer. Do the companies that you visit get it? And what are some of the low-hanging fruit?
Yeah, no, I think if you were to ask me this question 5 years ago, I'll probably say not really. But things have changed dramatically. I think with everything that we're seeing in the news, also movement from the youth, as well as just much better awareness across the investment community. Definitely, companies are telling us they're not just hearing from JP Morgan or the other two panelist firms, but they're hearing from across the board. It's the pace of change. It's painful, right? It's painful to go through some of these changes. It may hurt investment performance in the near term in some cases, right? So the challenge is, are you willing to accept that? But positive, I think it's trending towards a positive direction for sure.
Jeremy, quickly.
Yeah, I think awareness has increased, particularly, if you're a large emitting firm, you can't not have an awareness of these issues, because you are facing, your company is being valued in a way that takes this risk into account, right? Your stakeholders, your shareholders are raising questions about your strategy. You see the policy-making environment sort of shift. But so I'd actually say where there's more scope is actually within our own industry, right? I would sort of say that there's a long tail of financial enterprises, and asset owners that are really still appreciating why this isn't actually about what your own personal environmental view is. It's about, as Graham's made this point a couple of times, there's a big structural change in the nature of economic activity taking place, right? And if you don't understand the nature of it and what that means for investing, then you'll be left behind. And so it's that message that we need to get sort of through, not just the alignment with environmental objectives, which is also critically important, but it's that type of awareness that people need to understand. This is not a green issue. This is an investment issue.
Graham, the final word from you, 20 seconds or less, please.
Yeah, well, look, we invest in climate solution providers. So yes, most of our companies do already get it. But as I said, many of the EM names we invest in are further behind on the transition around carbon emissions reporting, around sustainability. But ultimately, the engagements we're having with them are extremely positive. They understand the risks, they see the opportunities, and they're very keen to work with us and improve, to really take advantage of, I suppose, long-term sustainability, which we think should drive alpha.
Excellent. We are out of time and we could go for much longer, but I would like to thank all of our three speakers today. Jennifer Wu, Global Head of Sustainable Investing at JP Morgan Asset Management, Graham Baker, Portfolio Manager 91 Global Environment Strategy, and Jeremy Lawson, Chief Economist and Head of Aberdeen's Research Institute. Thank you for joining us. Thank you all for joining us today. Sorry, we ran a couple of minutes over time. We will be sending you a feedback email, and we would really appreciate you sending that back to us, and that way we can get you your CPD certificate. We will see you again on Wednesday, the 17th of November, at the same time, to hear more from our industry specialists on how businesses are trying to incorporate responsible investment into their businesses and to help you do the same. So thank you once again, and it's farewell from me.